Hey everybody, this is Paul doing a impromptu update video. Just a few portfolio moves I've made, that type of stuff, and just doing an update on like life things that are going on and just my views on the market right now and how what I'm doing in my real life is translating into my market moves. So as it stands right now, basically I've joined, I guess, what they call the Great Resignation, if you want to call it that. So a quick rundown of that is basically I've decided to leave my current position where I'm at, and then my wife is back into the workforce doing something that she's always wanted to do, and then I'll probably end up going back in at some point since I'm in pretty high demand positions. I can go back in whenever I feel like. But right now, I decided to take a little break because I've never had a break. So what did I decide to do in response to that? So what you normally would do is you would try and stay you would try and reduce your debt. So the timing of when I decided to leave my position, and then also when the market decided to go into chaos mode, apparently, or whatever you want to call this, is actually lined up because the portfolio performance and value and all that. And right now, everything's running kind of interesting. But so if we go out to say 2 years, so for example, basically this is the 2 year performance. This effectively is starts COVID and then goes all the way up, whatnot. Um, you can kind of get a general idea of what's going on and why I might be pulling money out. So the Federal Reserve is effectively, I guess the best way that some people are describing it is basically the pedal has been on the metal very hard, and effectively it's kind of the same as if you are going like 100 miles an hour down the road, and then all of a sudden it seems like the Federal Reserve decided to just slam the brakes. So right now, your the car that is the economy is doing what you would kind of expect in that situation. It's jerking to the left and it's jerking to the right. You're kind of seeing that translate into the market. It's the only way you can describe what's going on right now. It's like basically somebody at the Federal Reserve realized we were going too fast and they decided to jerk the wheel to the left and to the right while they're slamming the brakes. It was pretty much that sudden, it seems. Um, the Federal Reserve is supposed to meet on the 25th and the 26th, so we should get the press conference, I think, on the 26th or the 27th. These are going to be two very, very, very important days. These 2 days right here, or whenever they do the press conference, will determine literally how the rest of 2022 goes. That press conference will determine if you have a positive portfolio performance in 2022, or if the market just completely just goes. The reason why is it's rates. That's all that matters. Rates. This affects borrowing costs for corporations. A lot of corporations have been borrowing against their own shares at lower rates to basically buy shares, do buybacks, that type of thing. So, as it stands right now, the most sensitive companies are going to be the ones in the NASDAQ because those are the ones that are considered growth. So, growth basically means that they'll grow someday. There's a few companies in the Nasdaq that are like very, very, very solid, like Apple, that type of thing. But there's a lot of them, like your Pelotons of the world, where they have theoretical business models, and they're not exactly growing at the moment. So, what have I done in response to this? So, since I got the personal things going on, so what I've decided to do is basically I sold out of my winners. So effectively, what I did is, if you look here, is I sorted by dividend yield and how I made this decision. In anything that was below 3.5%, because I needed to free up a very specific amount of money to pay off some of my larger debt, just to get my monthly bills down to a certain point that I needed them at. So what I did is I sorted by dividend yield, and anything that was below 3.5%, as you can kind of see right here, is what I sold off. And the reason why I did anything below 3.5% is for two reasons. One, typically that would mean that the stock price is so high compared to the value or compared to the dividend. So the price has been running very, very high and the dividend hasn't kept up. And you can clearly see something like that with Pepsi, obviously. You can see it with Coke beyond a doubt. Like last year, this time, this was a 3.5%. Uh, Procter and Gamble, even though the market kind of thinks we're going into a recession, it's kind of weird. And there's a few others here, but this was enough right here. This little bit right here was enough to completely pay off a majority of my debt. So that's what I decided to do there. And that's how I just made that decision. The decision was based on the dividend yield because what's going on is these rates down here have been skyrocketing, like shooting up at a tremendous amount, wiping off value from the NASDAQ, and I don't think it's done. It might be done for the day, but you can clearly see, you can just clearly see any miss whatsoever on your growth targets, and this is what happens to your stock. This is a dramatic, massive, just punishing move from the market. This is just punishing Netflix right now with a 22% decline because they missed subscriber growth. So basically, during the pandemic, everybody signed up for Netflix. They pulled the growth forward from like 5 years in the future. And now you see the consequences of that. They can't maintain that growth. They decided to raise costs at the same time, which is also going to cost them subscribers in the US and Canada. And there you go. That's the result. So that's kind of how that works right there. So where did I decide to put a large amount of money? Basically, I decided to actually get tech exposure. Passively get tech exposure. There's a difference. So what I did is there's a fund called BST. It's BlackRock Science and Technology. I never touched this fund before because it has a 1% expense ratio on it. Normally Vanguard funds, 401k funds, that type of thing, zero point 0.6 is considered high. Vanguard is at a 0.3 or something like that. This BlackRock fund is at 1%. I heard about it from the Joseph Carlson show. He's a guy who does YouTube stuff. He's like a dividend investor and whatnot. It pays out every month. Has a 6 point. It's kind of like a covered call ETF, like QYLD, but it has a different tax structure. Joseph Carlson was going over this. Basically, because of the way that they pay out like they pay out every month, it's considered long-term capital gains. At least it was for the last year, which means for me specifically, this is taxed at a 0% rate. So, and then this down here, I believe, might be taxed a little different, like say at I think 12% of the profits are, it's pretty high. But so this is taxed as long-term gains, which is really, really good. That's BlackRock doing their thing. They have a website and everything that goes along with this. I might make a video about it. There's a lot of videos about BST. It's a very good fund. So what I did is a majority of the money, I pulled the money that I didn't transfer to pay down debt, I moved into here. I took a large position in this. As you can see, it obviously makes up 15% of my portfolio. So if you take this right here and you take QYLD, that's 8.43. So that's about 25% of my portfolio is in tech-related type stocks. That's effectively what that means, like an ETF that pay out monthly. So it's more of a passive type approach. So in reality, I want the NASDAQ to go down. And the reason why is because if this goes down, because this is a passive long-term account that I have. So if you take this out to 3 years, you can see what might end up happening here. This was at $35 prior to the pandemic. There's a chance this could go back down to $35. Now, to remember, this is a passive investment strategy. So it doesn't matter what price I bought this at. So I'm not paying attention to this gains column. If anything, I might end up removing this column because at this point, it's completely pointless to me. But, so as it stands right now, what I did is I pulled my earnings that I made from basically here to about here. So I'm still up, but I pulled my earnings. So basically, I pulled my account value. See, it's at 50. It was at 72. Now it's at 59. I did a special update right here on my thing. So I pulled my account back to right about there. So right about to there. So the earnings that I made between April 1st and January 1st, I used that to basically pay off my debt. So this is a good example right here. So the 62, but you see how it says 30,000. Now it says 60 basically, give or take a little. and now it says 14. So I used the earnings to do that, and the reason why was my personal situation specifically. But it's something I had also been thinking about for a while too, because the market and the Federal Reserve are definitely sending signals that we're in the late game. Um, I mean, the Fed could end up saying to, like, oh, we're not going to go, as fast as you thought, and we'll go slow. I think they're going to be, I don't know. This press conference right here will literally determine how 2022 goes. I'm going to make another video on the 31st probably, but this press conference right here is the only thing that matters for 2022 when it comes to market investing. If you're like an active investor, if you're a dividend guy, I mean, you just continue to buy your dividend stuff. Because as the stock values go down, as the value goes down, the dividend yield goes up. So that's all you care about if you're a passive investor. So you just let the passive thing just do what passive things are going to do. But that's kind of my views on the market right now. I think the Fed could very easily break this market in one way or the other. And you can just kind of see it in the way that the bond market's been acting. Like, these moves are not normal. These are not normal moves. It's not supposed to do these large 80 basis point moves every day. Like, this is swinging the mortgage market around, and this is the market pricing in things. There's just a lot going on. So we're going to have to kind of see what the market decides it wants to do in the long term. But right now, the market is pricing in a lot of things. You can kind of see my portfolio value even swinging around throughout the day. But you can kind of see it, just a lot of weakness. Market just broke below 14,000. As you can see, it's already off 1.29%. Value stocks are rallying. You can kind of see that. MO is just one of those ones that's been doing it's just insane how great that one's doing. But this is a good example of why I got into BST also. If you look at it, so it's down 0.63%, but the NASDAQ is down 1.29%. It's because it's a broad market ETF, so it has pieces so there's not everything in the NASDAQ is down right now. A lot of it's down, but not everything. So that's why I like QYLD, and that's why I also like, if you look at QYLD also, I'm sure it's the same. It's actually, QYLD probably has big exposure like Netflix probably, but if you look at BST. So, but that's currently how the market's doing right now. Like I said, there's a lot of, this market is definitely on a needle's edge. It could tip over into a market recession. I mean, NASDAQ only has 10% more to go before you can have a declared recession in that. It's at 10% down already. And then, but this meeting, that Federal Reserve meeting, will be the big one. That's going to determine where this goes for the rest of the year and how a lot of people's portfolios shape up. But as it stands right now, this is where I'm at. As you can see, value stocks are doing very good. I'm already pre-positioned. I'm 100% confident that this, at some point, like 5 years, will obviously run back up. We're just, it's just a tech economy that's switching over. So this is a decent investment right now. And specifically works for my life situation. But as it stands right now, that's where we're at. Looking pretty good. Especially, having an up day on a pretty rough down day. But this market has been very, very brutal. As you can kind of see, as the headlines just hit, and then you get the crypto, if you want to call it that, but the crypto markets are just getting hammered. I mean, these moves are just crazy right now. So, but we'll have to see. I'll make another video on the 31st with some more thoughts on the Federal Reserve meeting. The Federal Reserve could come out and sound dovish, which means that they're not going to do as many rate hikes, and you will literally see the markets go up in a straight line. Specifically the NASDAQ. You will see the NASDAQ literally go up in a straight line. It will go very quick and very bad. If they say no, we this 4 rate hikes isn't enough, we're going to do 5, we're going to do 6, you will see this go down in a straight line. So we have to kind of see what the Federal Reserve is going to do. It's kind of sad that that's how it is, but that's just how the markets work. They rely on debt, and they rely on cheap debt. So, but like I said, buying the dip right now as it stands. and then we'll see where it goes. But let me know what you think. Leave a message in the record or in the comments, whatever you think, and then have a very nice day.